So you're scrolling Zillow at midnight, you find this beautiful three-bedroom house listed at $499,000, and you think to yourself, you know what, with my salary, I could actually do this. You run the mortgage calculator, the monthly payment doesn't look insane, and for just a second, you let yourself imagine what it'd be like to own a place like that. Then you close the app, go to bed, and never think about it again because deep down, something tells you the math doesn't actually work. And here's the uncomfortable part. You're probably right, but not for the reasons you think. My name is Leo, and I spend way too much time thinking about why homeownership feels impossible for people who, on paper, should absolutely be able to afford it. If you're someone making decent money, doing everything you're supposed to do financially, but still can't figure out how you're supposed to buy a house in this market without sacrificing your entire existence, hit subscribe and give this video a thumbs up because today we're going to do something most real estate content won't do. We're going to show you the actual brutal math behind affording a $500,000 house in 2026. And look, I picked $500K specifically because it's right around the median home price in most major metro areas right now. This isn't some luxury mansion we're talking about. This is a normal house, a starter home in many markets. And what we're going to find is that the income required to comfortably afford this house is going to make a lot of you very, very angry. Here's the thing, most personal finance content gets wrong about this topic. They'll tell you just follow the 28% rule or make sure your mortgage is less than 3 times your income and call it a day. But that advice was written for an economy that doesn't exist anymore. It was written when interest rates were 3%, when property taxes weren't $800 a month, when insurance companies weren't dropping homeowners left and right, and when a single income household could actually support a family. We're not in that world anymore. So let's actually do the math. And I mean the real math, not the fantasy math that lenders show you to get you to sign, not the math your parents used in 1987, but the 2026 math that accounts for everything that's actually going to hit your bank account every single month. A $500,000 house. Let's say you put down the traditional 20% because you've been told that's the right way to buy a house. That's $100,000 in cash. Already, we need to acknowledge that for most people under 40, having $100,000 saved is either the result of years of extreme discipline, a generous gift from family, or straight up luck. But let's say you have it. That leaves you with a $400,000 mortgage. At today's interest rates, and let's be realistic, we're looking at somewhere between 6.5% and 7.5% depending on your credit and the week you're applying, your principal and interest payment is going to be around $2,800 a month. Some of you just felt your stomach drop because $2,800 a month is more than you currently pay in rent, but we're not even close to done. Now look, here's what most people don't realize when they're running those cute little mortgage calculators online. That $2,800 is just the beginning. Property taxes on a $500K house, depending on where you live, you're looking at anywhere from $400 to over $1,000 a month. Let's split the difference and say $700. Homeowners insurance? In 2026, after all the climate-related disasters and insurance companies exiting from certain markets, you're easily paying $200 to $400 a month. We'll say $300. Oh, and if you didn't put 20% down, which statistically most first-time buyers don't, add another $200-ish for PMI. But wait, there's more. HOA fees if you're in certain neighborhoods or condos. Let's say $100 a month for this example, though it could be way higher. Maintenance and repairs, and this is where people really delude themselves. You need to budget at least 1% of your home's value per year for maintenance. On a $500K house, that's $5,000 a year, or about $417 a month. And before you say, I'll just not fix things, understand that deferred maintenance becomes exponentially more expensive. That small roof leak you ignore, that's $15,000 in water damage 2 years later. Let me add this up for you. $2,800 in principal and interest, $700 in property taxes, $300 in insurance, $100 in HOA, $417 in maintenance. That's $4,317 a month. And we haven't even talked about utilities, which are going to be higher than your apartment because now you're heating and cooling an entire house. $4,317 a month, $51,804 a year, just to keep the house. Now, here's where it gets interesting. The old rule was that your housing costs shouldn't exceed 28% of your gross income. If we use that rule, you'd need to make $185,000 a year to afford this house. But here's the problem with that rule. It's based on gross income, not take-home pay, and it completely ignores the fact that the cost of everything else has exploded. Let's be more realistic. Financial experts who actually care about your long-term stability will tell you that your housing costs should be closer to 25% of your take-home pay, not gross. Why? Because you can't pay your mortgage with money that goes to taxes and your 401k. You pay it with what actually hits your checking account. If you're making $185,000 in a state with income tax, your take-home is probably around $120,000 after federal taxes, state taxes, and retirement contributions. 25% of that is $30,000 a year or $2,500 a month. We're spending $4,317. See the problem? To actually afford this house, and by afford, I mean sleep at night, have an emergency fund, save for retirement, and not eat ramen every night, you probably need to be taking home close to $200,000 a year, which means a gross income of somewhere between $280,000 and $320,000, depending on your state and tax situation. Now, you might be thinking, Leo, that's insane. You're telling me I need to make $300,000 to afford a median-priced house? And here's my answer. I'm not telling you that. The math is telling you that. I'm just a messenger. And yes, it is insane. It's completely unsustainable, but it's also the reality we're living in. The median household income in the United States is around $75,000. The median individual income is about $60,000. Do you see the gap? We've created an economy where housing prices require incomes that don't exist for the vast majority of people. And then we act surprised when people can't afford to buy homes. This is where the psychology gets really important, because what happens when people want something they can't mathematically afford? They rationalize. They tell themselves stories. Well, I'll get a raise next year. I'll just cut back on other stuff. My partner will go back to work after the baby. I'll get a side hustle. And look, some of those things might happen, but you cannot budget based on optimism. You have to budget based on reality. Here's what actually happens when people stretch to buy a house they can't afford. At first, it feels fine. You're excited. You own a home. But then the water heater dies, $1,500. The AC stops working in July, $4,000. You need new tires, $800. Your kid needs braces, $5,000. And suddenly, you're on a treadmill where you're constantly putting out fires with money you don't have, going deeper into credit card debt, unable to save anything, stressed about every unexpected expense, and wondering why homeownership feels like a trap instead of an achievement. I know this is depressing. I know you didn't click on this video to have me tell you that you can't afford the thing you want. But here's why I'm doing this. Because the worst financial decision you can make is buying a house you can't afford. It will ruin your finances. It will ruin your mental health. It will ruin your relationships. I've seen it happen over and over again. The real estate industry, the mortgage industry, the entire housing industrial complex is designed to get you into a house, not to make sure you can actually afford it. Lenders will approve you for way more than you should borrow because they make money on the loan, not on your long-term financial health. Real estate agents get paid on commission, so they want you buying the most expensive house possible. Everyone in the transaction has an incentive to push you beyond what's comfortable. You are the only person looking out for your actual financial well-being. So, let's talk about who can actually afford a $500,000 house. Based on everything we've discussed, you probably need a household income of at least $200,000 to $250,000, maybe less if you're in a no-income tax state, have no other debt, and are extremely disciplined. Maybe more if you have student loans, car payments, kids, or live in a high-tax state. A down payment of at least $100,000 plus another $20,000 to $30,000 in cash reserves for closing costs, moving expenses, and immediate repairs. Little to no other debt. If you're carrying $40,000 in student loans and a $500 car payment, those numbers we talked about get even worse. Job stability. You cannot afford to lose your income 6 months after buying this house. And here's the part that's going to make some of you mad. You probably need to be a dual income household. I know the American dream was supposed to be a single earner supporting a family with a house and a white picket fence, but that economy is gone. For most people, affording a $500,000 house in 2026 requires 2 incomes. Now look, I'm not saying this to crush your dreams. I'm saying this because I want you to make informed decisions. And sometimes the most empowering thing you can do is acknowledge reality and then figure out how to navigate it. If you're making $100,000 a year and you want to buy a house, you have options. They're just not the option of buying a $500,000 house tomorrow. Maybe you buy a $350,000 house instead. Maybe you move to a lower cost of area where $500K gets you twice the house. Maybe you wait 2 years, save more aggressively, and increase your income. Maybe you buy a duplex and rent out half of it. Maybe you reconsider what starter home actually means. The goal isn't homeownership at any cost. The goal is financial stability. And sometimes financial stability means renting longer than you planned. Sometimes it means being creative. Sometimes it means accepting that the timeline you had in your head isn't the timeline that matches the math. Here's what you can actually do if you want to get to a place where you can afford a house. 1. Get obsessive about the real numbers. Don't trust the lender's pre-approval amount. Calculate your actual monthly take-home pay, subtract your current expenses, and see what's realistically left for housing. Be honest, brutally honest. 2. Treat your down payment savings like a non-negotiable bill. If you want to save $100,000 in 5 years, that's $1,667 a month. Can you do that with your current income and expenses? If not, something has to change.
3. Focus on income growth. I know that sounds obvious, but the math we just did shows that this isn't a problem you can budget your way out of at $60,000 a year. You need to earn more. That might mean switching jobs, learning new skills, starting a side business, or negotiating aggressively. 4. Consider non-traditional paths. House hacking, buying with friends or family, purchasing a fixer-upper, moving to a different market. The traditional path of save 20%, buy a single-family home in the suburbs is increasingly unrealistic for many people. And 5. Give yourself permission to wait. There is no prize for buying a house at 28 if it means you're financially stressed until you're 45. Sometimes the smartest thing you can do is nothing. Here's the thing I want you to understand. The math we did today isn't designed to discourage you. It's designed to prepare you. Because when you understand the real numbers, you can make real plans. You can stop wondering why everyone else seems to be buying houses and you can't. You can stop blaming yourself for not being able to afford something that mathematically doesn't work with your income. The system is broken. Housing prices have increased faster than wages for decades. Interest rates have doubled. Property taxes keep going up. Insurance is a mess. This isn't your fault, but it is your reality. And the only way forward is to acknowledge that reality and then figure out how to win within it. Can you afford a $500K house in 2026? Maybe. If you're making $250,000 as a household, have $120,000 saved, and have no other debt, absolutely. If you're making $80,000, not yet. But that not yet isn't permanent. It's just where you are right now. Build the income, save the cash, understand the math. And when you're actually ready, when the numbers genuinely work and you're not just hoping they will, that's when you buy the house. If this video helped you understand the real math behind homeownership, hit that like button. If you want more honest financial breakdowns that actually show you the numbers instead of selling you a dream, subscribe. And if you're sitting there right now realizing you're further from homeownership than you thought, but also weirdly relieved that it's not just you, drop a comment and let me know. I'll see you in the next one.